AI may change the world, but that does not mean every AI stock will make you money. That is the part many beginners miss. The internet changed the world too. But during the dot-com crash, even real companies with real products and real customers saw their stocks collapse. Some investors who paid the wrong price lost almost everything. So here's the uncomfortable truth. A technology can be revolutionary, and the stock can still be too expensive. The real question is not, is AI important? The real question is, how much of that AI future is already priced into the stock? Today, the market is divided into two sides. One side says, AI is the next industrial revolution. These prices are justified. The other side says, the AI story is real, but investors may already be paying for a perfect future. Both sides have a point. So in this video, I asked AI to explain why AI stocks are so expensive, why investors still pay high prices, and what risk beginners often ignore. This video is for education only. It is not financial advice. Let's break it down in simple English. Before we begin, comment below. Do you think AI stocks are still cheap because the future is huge, or already expensive because the market is too excited? Comment cheap or expensive. I want to see what side you are on. By the end of this video, you will understand 5 things. First, why investors are buying future growth. Second, why AI is also an infrastructure boom. Third, why not all AI companies are the same. Fourth, how FOMO pushes prices higher. And fifth, why a great company is not always a great investment. Because in the stock market, the biggest danger is not always buying a bad company. Sometimes the biggest danger is buying a great company at a price that already assumes everything will go perfectly. The first reason AI stocks are expensive is simple. Investors are not only buying what these companies earn today, they are buying what they believe these companies could earn in the future. In the stock market, price is about expectations. If investors believe a company can grow much faster over the next 5 or 10 years, they may be willing to pay a much higher price today. That is why fast-growing companies often trade at high valuations. A mature business might trade around 10 to 20 times earnings. But a high-growth AI stock may trade at 50, 80, or even 100 times earnings. Sometimes, if profits are still small, investors may look at price to sales instead of earnings. The exact numbers change, but the logic is the same. The higher the valuation, the more future success the stock price already assumes. So when investors buy expensive AI stocks, they are saying, this company looks expensive now, but I believe its future will be much bigger. That may be true. AI could increase productivity. AI could automate tasks. AI could reduce costs. AI could create new products. AI could open entirely new markets. But here's the problem. The future has to be big enough to justify the price. If investors pay today for 10 years of perfect growth, the company must deliver extremely strong results for many years. Not just good results, extremely good results. Summary. The higher the price today, the more years of flawless execution the company must deliver. And flawless execution is rare. This is where many beginners make a mistake. They see a company changing the world, and they assume the stock must keep going up. But the market does not only ask, is this company important? The market asks, how much of that importance is already priced in? Priced in means the stock price may already include the good news people are excited about. And when good news is already priced in, the company has to do more than succeed. It has to exceed expectations. The second reason AI stocks are expensive is that AI needs massive infrastructure. AI feels digital, but behind every AI chatbot, image generator, AI video tool, and coding assistant, there is physical infrastructure. There are chips, servers, data centers, electricity, cooling systems, networking equipment, cloud computing, software, and thousands of engineers. AI is not magic. AI is a very expensive computing machine. That is why the AI boom is not only about one app or one company, it is an entire supply chain. When demand for AI grows, demand for AI infrastructure grows with it. That is why investors are excited about companies that provide the building blocks of AI. Chip companies. cloud companies, data center companies, semiconductor equipment companies, enterprise software companies, cybersecurity companies, even energy and cooling companies. But here's an important point. Not every AI company is the same. There are three major types of AI businesses. First, infrastructure companies. These provide chips, cloud computing, data centers, networking, power, and hardware. They sell the tools needed to build AI. Second, model and platform companies. These build large AI models, AI platforms, and developer tools. They want to become the operating system of the AI economy. Third, application companies. These add AI into real products like office software, design tools, coding tools, customer service tools, financial tools, and entertainment platforms. Each group has different risks. Infrastructure companies may benefit first because everyone needs computing power, but they can face cycles, supply limits, and huge capital spending. Model companies may become powerful platforms, but they face high training costs, competition, and pricing pressure. Application companies may reach users directly, but their products can be copied, bundled, or replaced. So when people say AI stocks, be careful. An AI chip company is not the same as an AI software company. An AI cloud provider is not the same as an AI app. The better question is, where does this company sit in the AI value chain? Summary: AI is not one industry. It is a full value chain, and every link in that chain has its own risks. The company selling shovels in a gold rush can still go bankrupt. Now think about this. If you had to choose only one part of the AI value chain, which one do you think is strongest? Chips, cloud, AI models, or AI applications? Comment your answer below. The third reason AI stocks are expensive is the idea of winner takes most. In some technology markets, the biggest winners capture a very large share of the profits. Why? Because scale matters. The leading companies often have more data, better distribution, stronger ecosystems, more customers, more engineers, more capital, and more ability to reinvest. Once they become leaders, it can be very hard for smaller competitors to catch up. That is why investors are willing to pay premium prices for companies they believe could become dominant AI winners. The market is trying to identify the few companies that may control the most important parts of the AI economy. Who provides the chips? Who provides the cloud? Who owns the data? Who builds the models? Who controls distribution? Who has pricing power? But here's the twist. Even when the market correctly identifies a winner, paying too much for that winner can still destroy your returns. A useful historical example is Cisco during the internet boom. Cisco was a real company. It sold real networking equipment. The internet was real, and Cisco was essential to it. But during the dot-com bubble, the market priced Cisco as if the internet build-out would happen overnight. When the bubble burst, Cisco's stock fell over 80%. It took more than a decade to return to its previous peak. Not because Cisco failed, because the price got too far ahead of reality. The lesson is not that AI is fake. The lesson is that a real technology trend can still become overvalued if investors pay too much too early. Summary: a real winner can still be a bad investment at the wrong price. The fourth reason AI stocks are expensive is FOMO, fear of missing out. This is one of the strongest forces in financial markets. When prices go up, more people pay attention. When more people pay attention, more people want to buy. When more people buy, prices go up even more. Then the headlines get louder. Social media gets more excited. Analysts raise their targets. People start saying, "This time is different." And suddenly, everyone feels like they are falling behind. This emotional pressure can push prices higher than fundamentals alone would justify. People stop asking, "What is this company worth?" and start asking, "What if I miss it?" That is dangerous, because FOMO makes investors focus on the best possible future and ignore the downside. Have you ever bought a hot tech stock because you were afraid of missing the rally? Be honest. Almost every investor has felt that emotion. But history gives us a warning. The internet was real, but many internet stocks still crashed. Electric vehicles were real, but many EV stocks became too expensive. Crypto technology was real, but many crypto projects collapsed. The lesson is simple. A real innovation does not protect investors from paying the wrong price. Summary: FOMO makes investors buy the story before checking the price. The fifth and most important reason AI stocks are expensive is expectations. In investing, expectations are everything. A stock does not fall only because a company is bad. A stock can fall because a good company fails to meet extremely high expectations. Imagine a company grows revenue by 40%. That sounds great. But if the market expected 60%, the stock can still fall. The company did nothing wrong. It just was not perfect enough for the price. This is why expensive stocks are difficult. When expectations are low, a company can surprise people easily. But when expectations are extremely high, the company has to keep proving that the story is getting better, again and again. Quarter after quarter, year after year. For AI stocks, investors may expect massive revenue growth, high profit margins, strong demand, limited competition, and faster AI adoption. That is a lot to ask. If one part of the story weakens, the stock can become vulnerable. So, beginners should not only ask, is AI important? They should ask, what expectations are already built into the stock price? Because sometimes the danger is not the company, the danger is the price. Summary: the risk is not AI failing. The risk is expectations getting too high. So here's a simple framework for beginners. Save this part of the video because you can use these 5 questions every time you look at an AI stock. Question 1. What does this company actually sell? Do not just say AI company. Is it selling chips, cloud services, software, advertising, subscriptions, data center equipment, or enterprise tools? Understand the business model. Question 2. Is AI actually driving revenue growth? A good story should eventually become real sales. Hype is not enough. Question 3. Are profits growing too? Revenue growth is good, but if costs grow even faster, the business may not be as strong as people think. Question 4. How strong is the competition? If many companies can offer similar products, profit margins may fall. Question 5. What does the current stock price already assume? This is the most important question. A company can be amazing. But if the stock price already assumes perfect growth, there may be very little room for mistakes. Ask yourself, if this company does well, but not perfectly, can the stock still go up? This framework will not tell you exactly what to buy or sell, but it can help you avoid the biggest mistake, buying a story without understanding the price. Summary: do not just buy the AI story. Check the business, growth, profits, competition, and price. So, why are AI stocks so expensive? Because investors believe AI could become one of the most important technologies of our time. They are buying future growth. They are buying AI infrastructure. They are betting on winner-takes-most companies. They are reacting to FOMO. And they are pricing in very high expectations. Some of that optimism may be justified. AI is real. AI adoption is real. AI spending is real. And some companies may become much more valuable because of it. But the risk is also real. When expectations become too high, even strong companies can disappoint. So the real question is not, is AI powerful? The real question is, how much of that future is already priced into the stock? A powerful technology is not the same as a profitable investment. Never confuse the two. If this framework helped you, save this video so you can come back to these 5 questions later. And comment below. Do you think AI stocks are in a bubble? Or do you think we are still early? I want to hear your view. Also, hit the like button if you learned something new. It helps more people find this video. This video is for education only. It is not financial advice. In the next video, we will break down why some investors believe the US stock market may already be near the top. Is the market really too expensive? Are investors ignoring the warning signs, or is this just another false alarm before the next rally? Because in every bull market, there is one question nobody wants to ask. What if the good news is already priced in? If you want to understand markets with AI in simple English, subscribe for the next episode. This is MarketMind AI. AI explains markets. You make smarter decisions.